many who are under executing and burning enormous amounts of money, who now have to come back out to the market. As any sophisticated buyer will have to tell them the truth, which is, I'm sorry guys, but the data says there's a 60% discount to this mark. Are you willing to accept it or not? Otherwise the lights are going to go off. I was interested in a bunch of other funds that I'm invested in and their returns. And then I've also seen a bunch of leaked fundraising decks of all kinds of other firms, from growth stage to crossover to PE. And it's incredible that they are not standardized, right? Some people only show gross IRR. Some people show net IRR. Some people don't show the total value of the paid-in capital, which means, if you have a $100 fund, what is the total value of all of its holdings? Some people don't show DPI, which is distributions of paid-in capital, which means, okay, for every dollar you've taken in, how many dollars have you sent out? If you don't show all of them, what was shocking to me is how much you can kind of hide and play and manipulate the numbers. And one of the most crazy things that I saw is that there are these late stage funds that write into their fundraising decks that what they actually use are lines of credit to juice IRR. So what they do is, if they're about to do a deal, they'll actually get a loan from a bank, put that money into a company, wait until it's about to get marked up, and then what they do is they actually call that original money from their LPs and pay back their capital call line of credit. So what does it do? It inflates IRR. But this is why if you see the other numbers, it still shows that it's kind of like, not doing much of anything. So if you ever see huge IRRs with zero DPI and a marginal TVPI, it's folks that are playing games to trick LPs. Well, so it's dirty enough that the SEC has actually now introduced legislation, it was in February, that basically is going to try to uncover all of this nonsense. And so you'll have to be much more transparent. So the format that I used, in my opinion, is the most transparent way of not being able to hide the cheese. You show all the critical elements together in a simple table that will make it very obvious who's playing games and who can actually make money. If you have a reasonably well-developed infrastructure, you have a cash forecast of what deals you may or may not close with probabilities. And so you know what the weighted amount of capital you need to have on your balance sheet is. So I agree with you to have a small amount at the edges to pay for expenses, to pay for salaries while you clean up at the end of a quarter. Completely reasonable. But if you're making, 5 or 10% commitments into a company and you're using this as a way to basically create subterfuge and hide, I think that should not be allowed.
At the end of the day, what metric do we all look at when we are LPs in a fund?
Well, this is what I put down. I put down the ones that I look at for everybody else that I'm an LP in,
So what one is that for you?
I need to look at the totality of it. I need to understand what is your gross and your net IRRs. Those are important things to understand because it shows how efficiently you put the money to work.
Of course.
But then ultimately, the other two things that really matter is what is the total value you've created, and then what percentage of that have you given back to me? Because that allows you to understand how much paper value this. So for example, today, let's just say you had a fund that had a TVPI, total value of paid in capital of a 5x. A 5x on a fund is incredible. But if you've distributed none of that, well, guess what? If we're sitting here in May of 2023, or 2022 rather, the total value of your paid in capital is not really 5x. It may be only 3x, and it may be actually 2.5x considering what the markets have done to these companies, right? And so it allows me to really understand how performant funds are in not just being a part of the game, but actually generating realizations. And this is the hardest part, as I told you, Jason, like this past quarter, I think I passed 2x across my funds when I was managing outside capital. And I think, my gosh, it took me 11 years.
It's hard
to return 2x the money. And that means I've returned $2.5 billion. You know how hard that was? You can't even time the exit. You have to be constantly managing and working your portfolio. Sometimes you're selling in secondary transactions. Sometimes you're actually trading up in private markets where you help this company merge with another private company. Other times, if I think about it, the number of IPOs I've had is relatively de minimis. So how do you make $2 billion where I've only had one IPO, which has been Slack?
Yeah.
So this is a really, really hard business. And it was just a reminder that, in the last 4 or 5 years, managing capital has seemed relatively easy. But in these next few years, you're going to see who's really, really good. It's kind of that old Warren Buffett quote, you really, you can see who's naked when the tide goes out. If you look at the most fantastic organization in the world, if it were an investment manager, which is Berkshire, their long run 50-year track record is, around 20%, right? Gross. If you look at the most successful asset manager in the world, and I would put Blackstone at that, just incredibly good and best in class in probably 3 enormous parts of the worldwide economy: real estate, credit, and private equity. Their long run track record is that on $200 and some odd billion of private equity and another $100 billion of real estate, they've returned 2x. So that's what the upper bound is. Doubling people's money and generating 15 to 20% is the best you can expect if you are really excellent and long-lived. That's the best. The SEC, by the way, has solved this for mutual funds, right, and ETFs. There's very strict standard reporting, and I do think that as for example, like if you go to the big banks, and if you're an individual like a doctor or a dentist or somebody, and they will aggregate and pool capital and put it into these funds on your behalf, as an example. So, it looks like JP Morgan or Goldman Sachs is a, $50 or $100 million LP in one of these big funds, but in fact, it's just the sum of a bunch of folks on their platform. It stands to reason that if the SEC can actually mandate standardized reporting for private investing, it would actually be a really good thing, because all of these games will, and probably currently are, as far as I've seen in these presentations, tricking a lot of folks to put their hard-earned money into things that actually will never make money. And it's because if you selectively cherry pick how you present this data, you can tell a partial truth. So, I'm happy to be compared to any organization, but every time I hear somebody chirping about how good they are, my only comment is I just want to see your table in the same format as my table, and we can compare it, because it allows me to really understand. If you have the option to invest in a private fund, you have to understand that private fund has 2 huge negative things working against it relative to investing in the S&P 500. So you could put your money into a Vanguard ETF, or if you could put your money into a private fund, you need to realize 2 things. Number one is it is illiquid, not just for 10 years, but it could be illiquid for 12 or 14, or in, Friedberg's case, 16 years. So you need to get paid a premium for owning that. And then the second is, depending on the business model, you may have very high failure rates, which means that you need to really hit these outsized grand slam home runs. And if you don't, then you're going to be worse off than if you had invested in the S&P 500. So that deserves a premium. And so Jason's right, which is the S&P is between 7 and 8% over long periods of time, predictable compounding. You have to add another 7 to 8% for this illiquidity premium, and another 7 to 8% for the business model viability of, for example, being in venture. When you add those 3 things together, you do need to get paid basically in the low to mid 20s returns to be justified. Otherwise, you are much better off just owning the S&P 500. Much, much, much better off. By the way, just to talk about how difficult it is to convert paper gains into real gains. Let's just say, Jason, in your example, you had a fund that had these huge paper gains but haven't distributed anything as coming into this year, okay? Here's a little interesting data about the ultimate buyer of all of these tech stocks, which is the NASDAQ, right? People that buy stocks in the NASDAQ. Listen to this as of yesterday. More than 45% of stocks on the NASDAQ are now down 50%. So basically 1 in 2. More than 22% of stocks on the NASDAQ are down 75%. And then more than 5% of stocks, so 1 in 20, on the NASDAQ are down 90%. So you can use this to actually get a blended average. But what it means is that the ultimate buyers of tech stocks are taking a 60% discount to what they were able to buy even just 4 months ago. 60%. So there is no public mark that will support a private mark unless it's also discounted by at least 60%. Now think about that when you talk about this entire panoply of companies that have been overfunded, many who are under executing and burning enormous amounts of money. who now have to come back out to the market. Any sophisticated buyer will have to tell them the truth, which is, I'm sorry, guys, but the data says there's a 60% discount to this mark. Are you willing to accept it or not? Otherwise, the lights are going to go off.